Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the news that moves the markets. And back in the studio this week is Robert. Robert, welcome back.
It's good to be back, Miles.
Good. Yeah, glad to have you. And it's a good week to come back because gold's been up for the last week.
It is.
Yeah, you missed the downward movement.
That's coincidence.
You planned your vacation perfectly as gold was declining into the interest rate announcement that we were talking about over the last couple weeks and ended up hitting us last week. And now we're seeing a little bit of a reversal. So is it real? Is it fake? Is it hope? Is it imaginary? What do you think?
Well, we'll jump right in. You've had now 4 touches right there at the 1700 or slightly below 1680. This was the 4th time that gold had touched right there and shown support, which was also a Fibonacci level that we had pointed out. So it's not surprising to see a bounce from that 1680, 1700 level. I sent out an email to my clients right before this bounce happened, just pointing that out. 1, 2, 3, 4 touches of the same level. It's a fib level, so obviously not surprising to see the bounce. I sent out an email, luckily, 4 or 5 days later after the email, gold's popping up. Is it real or not? I guess time will tell. But if you're not on one of our email lists, I know that a lot of our advisors send out regular emails when there's something occurring in the markets. It's pretty timely. So if you're not on an email list and you're listening, then call us. Get on one of our email lists. We'll respect your email, not send you a bunch of stuff too often, but it's worthwhile to have insight from our advisors when something like that, is about to pop. Don't always hit the tops or the bottoms, but that was a pretty clear place for gold to at least show support and show a bounce like we're seeing.
Right. We've been in this long-term trading range after gold had its big run-up between 2016 and 2020, and we put that initial top in at 2020. We've had this multiple move back and forth between around, like you said, 1680 and the top end at, 2080. So it's been a pretty significant trading range, but as we've also pointed out, and you just mentioned, we're at a very shallow long-term correction, that initial 382 fib, which we've now hit 4 times. And we came into that, I mentioned this a couple weeks ago, we came into that with a couple other charting indicators like RSI divergence,
right,
which doesn't necessarily mean reversal long-term, but it does hint at the idea of at least a short-term reversal. So it's one of those stair steps or rungs on the ladder that you can comfortably put your foot down on and say, this is a price you want to dollar cost into. Well, now on the top end, if we shorten our chart and just look over the last 6-8 months, now we're coming into a bottom end of the previous short-term floor. It was a breakout point. So when we had that January 28th rise, where we're going from about where we're at now, all the way up to the last time we hit about 2080, right at where we're about now. Also on January 7th, we hit it again on May 16th and July 1st, and that was kind of the last bottom before we had a breakout on the way down. So floors become ceilings, ceilings become floors, and as Robert mentioned, we're at a long-term floor that we just bounced above, and now we're coming into a short-term floor, and I would like to see gold, even though gold's been down a few bucks over the last couple days, we're still up almost $100 from the bottom, and personally, I think if gold's going to continue up, we're going to need to push above this line that you can see in the chart short term and probably get above this final little right shoulder that's actually at the short term 382 fib, which is sitting right around 1800, 1805. So if it were me to start arguing that we're pushing back up towards that 2080 mark and possibly above again, I'd like to see gold maybe somewhere in the mid 1800s with a pullback to confirm the growth and then begin climbing from there. So I'd like to see us start taking some stair steps up, pushing back up towards that 2080 mark. Now, what happens if that is gold's plan over the next few months? We're coming out of the summer doldrums, and we would be coming out of the summer doldrums right at the point when gold is starting to show momentum to the upside again. And when do we usually see breakouts in the price of gold? Well, it tends to be somewhere around November, December, January. So it's very likely this systematic summer occurrence that we keep seeing every year may just play out exactly the way that we've been mentioning for a number of months now.
Yeah, and you mentioned RSI. I have to point out that on the daily chart of gold, when we were at that bottom, 1680, 1700, daily RSI pushed to its lowest level since mid-2018. And if you go back and you look at 2018 when RSI was down there again, that was the bottom of the gold price. So
Right.
I'm not saying that has to correspond, but I think it was interesting to note that RSI oversold big time. And here we are bouncing back up. RSI is moving.
And the reason we like some of these indicators is not individually on their own giving us specific pricing levels. Nobody can do that. But we do like when you see multiple indicators all kind of converging in the same general area at the same time, which means a number of people are probably going to see motivation to do something at that price. So that's why we were pretty confident we'd see a bounce at 1680 when we hit it again. And now we're looking for where we'll have some of the other breakout pricing in gold to possibly push it up again from here.
Yeah, we want to see continuation.
Exactly, because you like normal trading. Everybody likes normal trading. Doesn't matter if the news is good or the news is bad. As long as the news is what you thought the news was going to be, then everybody's happy. Case in point, 0.75 of a point interest rate bump. Exactly what people expected, exactly what they ended up getting. Not good for the markets, but the markets are positive. Not because the interest rates are up. Rising interest rates in an inflation-built market isn't good. It's more expensive to borrow money to invest in the equities market. It should be making the bond market look more attractive. However, the equity market's up. The Dow was 17, 18% down for the year. Now we're only down 11. The Dow has had a nice reversal back up, just like gold has over the last couple weeks. Why is the Dow going up? Not because money's cheaper and it's easier to invest. It's simply because we got exactly what we expected.
Yeah, first 2 quarters, those people in the markets looking forward were expecting recession. And here we are. Well, the market is forward thinking. And what did silver do? Silver was declining as the market participants expect recession. So that makes sense. I'm wondering if the sell-off in silver all the way down in the 18s, I'm wondering if that was the market expecting recession and that has completed the expectation in the market's recession expectation. I'm wondering if that's done, because here is silver popping up above 20. And is all of that expected recession sell-off in silver over? That's a big question, I think, that maybe we can't answer today, but I think that is a big reason why silver did come down, is the expectation of recession, forward-thinking expectation.
Right, and going forward on silver, I mentioned the 1850 range that I'd like to see gold get up to. Silver for me is more in the mid 22 to mid 23 range. I'd like to see silver move above the last little bump we had on the way down back in the middle of May, bottom in May 12th. I think we hit a little high point there about a week later and then drop down to, as you mentioned, the 18 mark. So I'd like to see us start stair-stepping up in silver alongside with gold, and I think those two things would coincide. Now, I mentioned the Dow a second ago. The Dow is actually getting pretty close to what I would argue may be a decent point to say we could have a little bit of growth in the Dow. I'd like to see the Dow get above about 33.3. There's your 50% retracement. That means we've recovered back what we've come down, and you've got some previous lows and highs on the chart that you can see here. So I'd love to see the Dow get above that pricing. On a more fundamental basis, I don't really know what's propping the Dow up right now. I know the average American's spending has increased dramatically this year with food and gas and everything else increasing in cost. So the amount of money we all have to invest has obviously been decreasing, and the amount of money banks have to invest has been decreasing because of the rise in the interest rate. So I'm not entirely sure what's propping the Dow up right now, or at the very least, what's going to cause it to continue to push forward into the future. Right now, I can see where some profit taking may be taking place on the short side that's causing this rise, but I don't believe that we're going to see a strong Dow going forward, and the expectation of recession nationally is increased dramatically. I don't think the average person thinks it's going up either.
Yeah, I know why the Dow is going up.
Enlighten me.
There's more buying than selling.
Thanks.
Well,
That's
a simple answer. Sure. There's something in, I think, looking at what happens at the very beginning of the year for a market. And you kind of have to think about this relative to when tax time is. If you're going to sell anything at a gain, well, you've got to pay your gain tax. So if big institutional money wants to get out of a market, Would they do it at the end of the year or the beginning of the year? Probably they'd do it at the beginning of the year if they're wanting to get out of the market, because if they sell last week of December, they owe taxes on those gains in April, 4 months later. Where if they wait a week or two and let the end of the year roll into the new year, they can unwind and sell after the first of the year. That gives them another 16 months before taxes are due on that money. Time to play in the markets with 16 months of that money without owing the gains. So a market can give you a very good indicator of what big money is doing at the very first of the year. And so look at what happened in the stock market at the very first of the year. You had massive institutional selling in the stock market that was obvious, taking gains. And that usually will indicate which direction the market is headed over the course of the year, which, as we've seen, the markets continue to come down. Now, institutional money cannot just on one day say, we're going to get out of all our stocks. There's too much money to sell. There would be more selling than buying.
And that would cause the market to go down.
That's right. That's
I learned something today.
So institutions have to take time to sell, which is why back in 2007 and 8, the market actually peaked in 2007, but it didn't actually fully roll over and crash until about a year later in 2008. So I feel like this is what we've seen the first 6-7 months of this year, is you've seen institutional selling where they sold significant amounts in the first few weeks of the year, propped it back up a little bit, but it failed to go to a higher high, which indicated we might be headed into bear market. Now it's sold off, bounced back up, sold off. But you haven't seen the type of crash we saw in 2008 yet. But it looks like the market has clearly peaked right there at the end of last year, institutional selling throughout the first 2 quarters of this year. And where do they get all the money that they want out before they do let the capitulation happen? And I think that's what's coming in the next, 6, 9, 12 months. That's very likely that that's the situation that we're seeing right now.
Right. And I think the average American agrees with you. I think we're seeing that across the board, and that's why the White House had to put its press release out about what the definition of recession is that we talked about a couple weeks ago. You know, it's funny, this reminds me, Robert, back a few years ago, 2019, 2020, we were talking in here and trying to liken the way the market was going, because obviously the initial shock of COVID in March of 2020 had a very negative short-term impact on all the markets, equities, gold, everything. And the question flying around, obviously, was, are we kicking off 2008 again? I think our general consensus in here is, no, it's about 2005. As you were mentioning, you're starting to see the volatility. I think I brought up when Rob was on the show a couple weeks ago, we looked at the VIX. And the bottom end of the volatility index is starting to rise, meaning that as volatility declines and people get a little more comfortable again, they're not quite as comfortable as they were a few months ago, the last time they were comfortable. So the baseline of the VIX was starting to rise just like it was previously during that era. So I think you're right. I think what we're seeing, this volatility that precludes the capitulation, and we want to make sure we're not jumping the gun on that as far as our estimation of the timing and where we think the Dow could go from here prior to that happening.
So speaking of buying and selling, as people are getting uncertain about other markets, I feel like there will be more buying in gold than less, which, what did we say? That actually drives the price up. That's what I think is coming over the next few years. So thanks for listening this week. You can follow us on Twitter at ICA Gold, like us on Facebook, McIlvaney Financial. Click the subscribe button below, give us a like. You can find information at McIlvaney.com or give us a call at 800-525-9556. Thanks for listening. Have a great week.